By continuing to access this site, its content, or establishing any contact with Elliott Wave Live, you acknowledge having read and understand all disclaimers and risk disclosures. The following information described within this video or blog post contains information pertaining to hypothetical trades. These trades were not executed and are for educational or illustrative purposes only. Please read the CFTC Rule 4.41 that's on your screen, and keep in mind, by continuing to use this site, establishing any contact with its author and/or clicking on any of the links, you acknowledge having read and understand all the disclaimers and risk disclosures contained within my blog site. Hello, my name is Mike Sinibaldi, and welcome to this week's video edition of Heard on the Street. In this edition, we're going to take a closer look at the S&P, the price action, and the technicals that led me to call 1227 to 28 top. But first, I want to thank all my supporters of my work and propose a question to everyone. Do you trade what you see or trade what you think? I hope it's what you see. I got a lot of direct messages this week from some bulls, and my message remains clear. I'm unbiased, yet trading what I see, not what I believe in. It's a very difficult concept to grasp, let alone perform, since hard-earned money is involved. Yet each and every time the market provides the clues, both technical and from an Elliott Wave standpoint. It continues to do so. Watch as I'll recap the signs. It's a great trading lesson. At Elliott Wave Live, we academically count waves, but do we really care what the count is once the buy-sell button is hit? We don't. It's the post-pattern expectation of what should be happening that matters. I'm certain that many traders on this call have made money on a trade even though their count was incorrect. They made money because they were forced to trade what they saw, not what they thought the count was. I provided a link at the end of this video that was provided by Joe Ferranzano at Trading Cycles. It's an absolute hilarious video pondering what I've just described. Thanks, Joe. I want to start this video analysis with a chart that I posted on August 31st. If you've been following my blog, you know that I identified the 1227, 1228 area as a possible termination point for Wave 4 Circle, but that the last few subdivisions didn't count well. When I make that kind of statement, it means that there are several ways to count the structure, and a larger degree of uncertainty exists for my liking that warrants looking at further confirmation. On September 1st, I happened to be looking at this 360-minute chart level of the Emini S&P, and the last three bars look suspiciously like an ending diagonal. And just a day earlier, I made a case for 5 down, 1, expanded flat 2, 3, 4, 5 on this 7200 tick chart, and that wave 5 may be underway. The fact that price met resistance near the stated fib targets and the fact that it appeared that an ending diagonal was present allowed me to maintain my position and that a turn had been made. Further confirmation came when price broke 1192.50, and I tweeted on September 2nd that price violated 1178.75, and there was no way to make any further short-term bullish case from the 1118.50 low. If you're wondering where I'm going with this short recap, it's the fact that the larger degree turn and count allowed me to stay with a trade what I see mentality rather than what others thought. For example, at the monthly chart level, the 2007-2011 analogy is still on track. I mentioned in a previous tweet that the rally was done by the end of August. As you can see, I didn't pull that out of midair. In both the August of 2011 and January of 2008 monthly bars, large retracements occurred, and according to the analogy, both monthly bars ended the rally and the following month was down. Currently, you are here and you were here in the analogy. Therefore, we expect September to be a down month. Seasonally, this is also the weak time of year. What transpired this week continues to bolster both the larger degree analysis and confirms the weekly, daily, and intraday price action. As I have said so many times, I will continue to maintain this view until the analogy breaks down. So far, it's been money since July 17th of 2011. So why start trading what you think? Before we get into the actual projections for Wave 5 low and physical count, I'd like to share some technical pages that also gave me the confidence in maintaining the call for Wave 4 circle top. At the daily chart level, the SPX gave 3 confirmatory technical signals that the rally from 1101.54 was a corrective move. First, notice how the RSI found resistance at 60 and has turned down to break the 50 level. This is a classic signature of a counter trend move. My expectation is for the indicator to drop below 40, indicating a resumption of the larger trend down. Secondly, the rate of change was barely able to break the zero line, a weak momentum signature, as price approached the fib resistance targets. My expectation for this indicator is to drop below the zero line and create a divergence as price hits a new low. And finally, volume declined as prices rose, a sign that institutional investors and hedge funds did not step up and buy this market heavily. I look for volume to pick up as price declines, making new lows. And finally, if we use the classical head and shoulders pattern to generate targets for Wave 5, then Wave 5 should equal a 0.618 multiple of Waves 1 through 3 and terminate at 1062.75. I should be able to create additional fib levels as more of the wave structure unfolds. For Monday, look for an update on my intraday count and what to expect moving forward. And finally, for those who are interested, here's the link to some light humor on trading what you see. I hope you found this video helpful, and best of trading.